Hello everyone, and welcome to your Glassnode video report for week 35, 2022. So Bitcoin is hanging on by a thread. We've seen prices trade back down below 20,000 at the back end of last week. We have since recovered to about 20,200, but clearly we are down near the bottom of the range. So really what I want to explore today is some of the dynamics. We spoke last week about where that weakness was starting to set in, and we've seen that really manifest yet again this week. So just exploring some of the dynamics, what's going on under the hood, and what is actually getting Bitcoin to sell off with such an extreme manner when really it doesn't actually look like there's that much additional sell side pressure, which does indicate maybe there's a little bit of weakness under the surface. So as I mentioned, we've had a bit of weakness in the short term, and we really need to explore this concept of short versus long term in this session. And this is, obviously we talk about short and long-term holders. This is a statistically derived term we use with our supply dynamics at Glassnode. But what I'm also going to explore is just in terms of time horizons. We can have longer term trends that actually look quite constructive, but these things take time to play out. And bear markets, if you really zoom out and you look at it over multi-year time frames, they're big sideways consolidations at the end of the day, generally speaking. But in the short term, obviously, we can have periods of time where it trends down and for many months at a time. So, really, it's about understanding what the dynamics are on both the short and the near term and how that compares to the long term, because these things are a process. Markets take time to reverse, they take time to put bottoms in, and they take time to actually have a bull run and then transition into a bear in the first place. So these things do take time, and we're going to explore some of those dynamics across those shorter term and longer term timeframes. So as usual, please do give us a share and a subscribe. It does help this channel. Hopefully you find this particular session useful. We're going to explore a concept of lifespan in particular. We're going to open up with that and really explore what's going on that actually drove the prices down to 20K and what we can discern from a number of metrics and whether we can see that consistency across both spending patterns and in terms of the age of coins that are on the move. So let's get started. So starting with our price chart here in our week 35 dashboard, we can see that we have broken down yet again. We're essentially hovering around the bottom end of the range. And as I mentioned at the start of this session, we did break below 20,000. We got down to about 19,600. So we did in fact get back down below the 2017 all-time high and are currently in the process of attempting to hold that level. So when we look at these types of things and we see this kind of sell side action, what we generally want to look for is who was involved. Are we seeing a widespread loss of conviction? Are we seeing that the long-term holders and those people who have held their coins for a long time, are they essentially throwing in the towel and saying, that's it, Bitcoin's going to zero? Or is there something else that's going on? And one of my favorite metrics and actually one of the most powerful tools in on-chain analysis is the concept of lifespan. Now, lifespan is a concept that actually isn't replicated really in any kind of meaningful metric in the traditional finance world. It is unique. Bitcoin really has the most distinct lifespan profile because of its UTXO-based model and obvious size. What lifespan looks at is the age of coins that are on the move. Now, it's quite a nuanced topic. It does take a little bit to understand it, so I'm going to explore this from a few different angles. So we're going to start this with a metric called ASOL, which stands for Average Spent Output Lifespan. Now, an output is a technical term within a Bitcoin UTXO type model, but suffice to say that when you spend a transaction, you are spending outputs. So think about those as the net result. When you spend a transaction, you move coins from one address to another, it creates a new set of outputs. And then when you spend those, they become the inputs to a transaction, which creates a new set of outputs. So when we look at the average spent output lifespan, we don't care about the volume of BTC that was moving. All we care about is how old, how long has it been since those outputs were created. Now, higher values, this is a very basic model when we look at lifespan. Higher values typically suggest that older coins are on the move, and lower values suggest that younger coins are on the move on average. Now, remember, this particular metric doesn't care about coin volume. We don't care about BTC volume here. So moving 1,000 BTC that's 5 years old has the exact same weight as moving 0.001 BTC that is 5 years old. So when we're looking at lifespan metrics, we typically have to look at them in a few different sets. And we're starting with ASOL, and then we're next going to look at Dormancy, which does consider coin volume, and we'll see how they distinguish each other. So you can see that typically during bullish markets, you can see during the 2021 phase, during the August rally that we had back here in 2021, we typically get an uptick in ASOL. This means older coins are coming back to life. They're being spent at a larger majority. This is profit taking. Generally speaking, we see ASOL spike during two events. Bull markets, which is the typical occasion, literally profit taking by people who bought their coins a long time ago, and during capitulation events. Here's May. See this big uptick we saw during May 2021? This is a capitulation style event. We also saw it here as we kind of sold down into this 30,000 level. We saw a large uptick in ASOL. And then here's that uptick as we traded down below the 20,000 all-time high. Now you can see that in recent weeks, we've started to see a pickup in ASOL. So that means that on average, the coins that are on the move are older than they were recently. And we generally see this again during profit-taking bull markets and during capitulation events. Now, we're not really in a bull market at this point in time, but we did see a sell-off. So this is telling us that we saw a lot more older coins on the move during this sell-off. It's not extreme. It's not really the most exciting spike, but it did tick a little bit higher. So there's our first piece of evidence. Some of those older coins were on the spend, and maybe that means there's a loss of conviction. It's kind of our first take, but then we have to dive in just a little bit further to confirm that. So this is where we go to dormancy. So where ASOL is the average age per output, or per transaction is probably the way to think about it. Average coin dormancy is how old was the average BTC that was moved. So we look at all of the transactions that happen, all the Bitcoin volume, we have the age of those BTC, and then we take an average age. Now, as I mentioned before, higher values you can see here in the bull market, dormancy tends to spike during bulls, profit taking, older coins coming back to life. Note that really since January 2021, which was really where we had the height of a lot of the excitement, and then we had this kind of slow topping pattern through to April and May, note how dormancy over this period of time has more or less been in structural decline. So this is very typical of bear markets. We see that there are more of those older coins are going into cold storage. People are buying and putting them into cold storage. The bear market weathers on. We get periods of inflows and outflows, but generally speaking, the longer that a bear market goes on, we typically see this big scale dormancy compression. So whilst we saw an uptick in ASOL, meaning that there was lots of older outputs, lots of older transactions, note how we really didn't see a great deal of coin volume that was older. It's a little bit of an uptick, but it's nothing compared to what we've seen through most of the bear. So what we're really seeing here is that, yes, a lot of older transactions were on the move, but when you look at how much coin volume they carried, it wasn't actually that significant. So the way to think about this is that yes, older coins were on the move, as suggested by ASOL, but it wasn't exactly at large volume, which therefore gives us a bit more confidence that yes, some people kind of sold into this rally and took profits or, exited their stash when they finally just couldn't handle it anymore, but they weren't a significant amount. It's not a loss of conviction. If we got an uptick in ASOL and a very significant uptick in dormancy, or coin days destroyed is very similar. If you saw an uptick in all of those metrics, now you start talking about a significant flush out. So it's kind of showing you how we can use different components of this lifespan concept to explore this particular model. And what we're seeing here is that there was a little bit of spending, but it's not really a loss of conviction. It's not a widespread loss of conviction based on these metrics. Now, in a much bigger time frame, we have our supply-adjusted coin years destroyed. So dormancy is the average age per BTC. Coin days destroyed is just the total amount of age. And we can measure that age, obviously, in many instances. We can look at it in terms of days or years or months. How many BTC years have been destroyed? Now, what we're looking at here with coin years destroyed is over the last 365 days, how much lifespan has been destroyed in years as a unit. So naturally, during bullish markets, we can see that we get this uptick in coin years destroyed. These are older coins coming back, taking profits. And during bear markets, note that as we got to the all-time high, this really started to decline. This is showing that alongside our dormancy, that there is less age being spent. Now, this generally tells us, again, it's not a bottom formation signal. It's one of these macro oscillators that takes a long time to play out. But what this piece of information is telling us is that over the last year, we've seen a notable decline in old coin spending. Now, again, this means that both the older coins are staying stationary, which is good because they're not being spent, they're not losing conviction. But simultaneously, when you get these depressions in this particular model, note here at the bottom of the 2018 bear, you get this local low. Following March 2020, we had another local low. Typically, this model will descend and reach some kind of bottom formation around the same time that a bear market is coming to the end. Why is that? Because we're seeing all those coins get sucked out of exchanges, going into investor wallets where they start to mature. They're not spending because their conviction is high. They see cheaper Bitcoin and they are slowly buying. Eventually, the bottom gets put in. And then, of course, the bull market begins. And they start taking profits and spending those older coins that they've held onto for a year or 2 years. They've accumulated, they've held it. Now they're taking profits. So it makes sense that this metric will essentially cycle up and down, much the same as bull and bear markets. And as you can see at the moment, we are at a relatively low level. And it has been in macro decline alongside our dormancy chart. So the big picture takeaway from here is saying that even though prices are traded down below 20,000, we are yet to see the back get broken on all of these long-term high conviction Bitcoin holders. And after such a long period of time, there's just sadly not many other people left. So that means that our near-term demand profile is not great. And we'll explore this more in a second. But it also means that the long-term conviction of those investors is essentially unbroken, which is a very, very interesting dynamic. So the way to think about it is that the conviction is there, but the number of people, here's our active entities. Think about this as like the user base. There's not many of them left. See how we're at the lower end of this kind of long-term channel, this long-term trend line that we have? Bear markets, we typically see, you can see the bull market activity here and here in 2017 and 2020, but you can see that the bear market channel is notably lower. Now, right now, it looks like essentially, we've been talking about this for some time. There's only the hodlers that are left. But we're essentially scraping the bottom of the barrel for how many hodlers are left. We're at the bare minimum. But note that at the bottom, it's almost that darkest before the dawn type concept. And again, we don't know when that darkest phase is. There's a lot of signals saying that this is very similar to previous bear market bottoms. And of course, things look the most grim at the bottom. So where we are at the moment, it looks pretty grim, which could signal that we are closer to a bottom. We're getting to that darkest phase, and hopefully the dawn is just across the horizon. But what this also gives us a bit of a framework for is we really don't have that many reinforcements coming in. So it's a bit of a double-edged sword where we don't have a lot of demand, quite structurally. There's very, very limited demand for Bitcoin at the moment, even though prices are lower and even though there's more, investors can get more BTC per dollar. It's still looking a little bit grim on chain. Now, if this deteriorates further, that would potentially signal that maybe it really is just pure weakness. But simultaneously, it is often the darkest before the dawn. So it's one of these things we're going to have to monitor over coming weeks. But between all of these metrics we've just explored, you can see how there's kind of this long-term conviction even though we have short-term weakness. And this is where it becomes important to really understand your time frames and how these markets tend to play out over time. So I just wanted to quickly jump in and give you a quick update on some of the things that we've got going on over at Glassnode. There's a lot happening and there's a lot of new content that we're pushing out, particularly for our paying members. So we've recently launched a new initiative on Glassnode Forum called Market Pulses. And what we're trying to capture here is these higher level concepts, a bit more advanced content, exclusive member only content. Recently, we talked about a bit of an update on Bitcoin's utility, looking at transaction flows, looking at, similar to what we just explored, looking at how the overall on-chain activity of Bitcoin, what is it telling us about the near and the short term overall outlook for BTC. We did a whole section where we look at lifespan, spent outputs, and spent volumes to really break down how you use ASOL, Dormancy, coin days destroyed, and comparing the difference between outputs and volumes. And we also looked at an analysis of network participants, looking at means, medians, skews, all these types of things. Now, within these market pulses, we also try to show you how we are using Workbench and trying to get the most out of Workbench itself. So really trying to make the most of the tools that we have available on Glassnode. We are really pleased to have launched 3 new languages. We launched Spanish, Portuguese, and Turkish. You'll find the Twitter handles of our lead analysts and the Twitter and Telegram handles of the official channels. And just before we get back to the action, we're coming into the last few days, valid until the 31st of August, to celebrate our coin market cap reports that we've been doing with them. And there is another one coming up very, very soon. We do have 1 month free on Glassnode advanced subscriptions. This is for a yearly subscription. So use this code CMCGN at checkout. And this is valid until the 31st of August. So this is closing out in the next 2 days. So jumping back into our overall analysis, what we're looking at here is now the spending behavior. We've established that long-term versus short-term outlook. Now I want to bring it into the spending domain in terms of the profitability and some of the mechanisms that kind of led into this recent sell-off. So what we have here is our net realized profit and loss. So this is looking at all the coins that moved on a particular day, were they in profit or loss, and taking the total sum. So if on average all the coins that we're moving were in profit, it's going to return a dollar value that is positive. And likewise, well, and more relevant for us at the moment, these red values are signaling that it's negative. Losses are being realized, and that's showing that there's essentially capital outflow from the system. Now, what I want to highlight here, you can clearly see the scale, multi-billion-dollar capitulation events when Luna collapsed, and then again as we traded below 20,000 the first time. Now, we clearly traded back down to 20,000, but you can see how much smaller. This is about $220 million a day. This was what was this? $2.2 billion a day. So just an order of magnitude different in terms of scale. And you can see that even with such a small amount being spent, we still sold off. Now, we also saw that exchange balances have not ticked higher this week. They actually ticked lower. So the way to think about this is we had a minimal amount of losses being realized, and we actually saw net coin demand out of exchanges. So really, the day-to-day price action and many of the macroeconomic factors, even within that daily trade volume, the weakness was in there. So it gives you a bit of a scale that it's almost like a bit of a sea breeze is enough to push Bitcoin back down to the 20,000. So it does put the bulls a little bit on the back foot, where not that much losses need to be realized in order to essentially create that sell side pressure. So it does err a little bit on the grim side when it comes to the overall demand profile. And we can see this very similarly with aSOPR. So aSOPR, what this is mapping out is the profit multiple. You can see that when it came back and retested from the underside recently, we got rejected. This is essentially showing that investors are willing to sell at their cost basis. Just get me my money back is the psychological element here. So this is very typical bear market behavior. You can see that we typically see that a value of 1 is resistance through bears, and much the same, it's actually a support level during bulls because people during bull markets. People are willing to add to their position at their cost basis because that's where they see value. So what we're seeing here is that we are breaking up against it and being rejected. What we really want to see for a sustainable level of momentum and actually a recovery of this market, we want to see aSOPR break up above 1, ideally get well above it. Actually, here's a great example back here in August. The reversal of a bear market, as I mentioned before, you need people to be making money because it means there's enough demand to absorb the sell side, and that allows the market to push forward. So note this break above that we had here in late July into August. Came back, we had a nice retest of 1, and then away we went into high profit. So this is essentially that reversal we want to see. We want to see aSOPR get above 1, come back at a nice retest, a bit of a gut check, and then a strong bounce, and that will generally give us a bit more confidence that we may have something more sustainable on the horizon. Note that sometimes these can fail, so you need to just be aware that there's noise in these metrics. But as with many things, once we get a sustainable break above and it can actually stick the landing, generally a good sign. Alongside some of the metrics we looked at this week and last week, that will give us a signal of a more sustainable recovery. And getting towards the end of this session, we're looking at the long-term holder SOPR. So the same thing, it's a profit multiple, but we're looking specifically at investors that have held their coins for more than 5 months. Statistically speaking, they are the least likely to spend their coins. Now you can see here that we've been in below 1 territory for some time. We got down to around 0.6, which means that on average, long-term holders are locking in 40% losses. This is pretty significant. 40% losses. I mean, back down here in 2018, this is one of our worst periods of time. We got down to about 0.5, which means 50% losses on average. But most bear markets typically bottom around 0.55, 0.6. So we are in this kind of same range of max pain. This bear market has been inflicting a severe amount of pain. It's not quite as bad as previously, but it's certainly in the same ballpark. And long-term holders in particular, let's actually zoom in on recent history. They've been underwater here for a number of months. Really, they broke down below here in May. So long-term holders have been being flushed out over time. Again, market bottoms and these processes, they take time, and we still need to see the bulls really put in that line in the sand if they're going to hold that 20,000 level, and they are being tested and they are being driven back by not a great deal. So really what we want to see is, can we get that upwards momentum? Can these SOPR models actually push back above 1, profits get taken, and that potentially puts us into a more sustainable recovery. Until that happens, however, the bulls still are on the back foot, and we're seeing this across a number of models, as well as just this general sentiment where investors are like, just get me my money back. So it's a very interesting dynamic, but certainly we are not out of the woods anytime soon. And just to close out, we're going to look at our overall market profitability. So what we're looking at here is the profit and loss return band. So essentially these red colors are people who are locking in minus 80%. And these slightly more orange colors are 20% to 50%. So we're looking at all of the market spending. What is the overall kind of losses being locked in? And you can see that essentially we are the second largest overall loss, eclipsed only by the 2018 low. So even though we are still struggling to get a bottom put in, what we do have behind us is the second largest capitulation that we have ever seen. So this bear market has left a mark. It should be of no surprise investors are willing to just get my money back, just get me out at whatever price, take whatever exit liquidity is there. What we really need to see is the bulls put in a firm line in the sand and actually get a bit of recovery across both on-chain activity, across SOPR metrics, saying that there's profits being taken, and just generally see that macro reversals. We come out of this thing if it is indeed getting towards a late stage of this bear. But there's still a rocky road ahead. We still have to see how this plays out, but hopefully that gives you a bit of a view on what's been going on in the last couple of weeks to really just demonstrate the scale of how bad this bear has been, but also that there are symbols that things are getting a little bit better, even if the bulls are on the back foot. So thanks as always for tuning in, folks. Hopefully you found this session useful. Do check out the adjusted SOPR metric. This is really one of those powerful models. We're really looking for that break back above a level of 1. That would signal that we're starting to get back into a profitable regime, which really is synonymous with a more bullish trend. So that's one of those models to kind of pay attention to, putting something like a 7-day or even a 30-day for that macro overview in terms of a moving average. If we get a break above on a 30-day and it sticks the landing, that gives a bit more confidence that there is actually the profitability returning back into the system. So until the next one, I'll see you then. Cheers.